Okay, so let's see the situations. So in this case, P acquired S in 2 successive purchases. The questions mentioned, NCI's non-controlling interests are deemed to have a proportionate interest in the fair value of subsidiary as an entity. So they suggest us how to calculate the NCI. So NCI is calculated as a proportionate interest in the fair value of S as an entity. You should know how to calculate, right? Are we using full GUIL method or partial GUIL method? Partial? So what is partial GUIL method? Partial GUIL method means NCI is measured as a proportionate share of the fair value of the identifiable net assets of the subsidiary. Why? Fair value of the net asset is not the same as the fair value of a company. Why? Fair value of Hong Kong Bank is not the same as the fair value of the net assets of Hong Kong Bank. We are not using the fair value of the net asset. We are using the fair value of the company. Fair value of Hong Kong Bank now is around $60. Right? If you go to a stock exchange, you buy 1 share, $60. Fair value of the net asset for Hong Kong Bank, $49. You check the annual report, you can read, right? So fair value of net asset is not the same as the fair value of a company. Here we are asking for the fair value of the company as a company, right? As an entity. So this is not the fair value of the net asset. So this is not partial GUIL method. No. Okay, so later we can verify, of course, right? Because later we can calculate the goodwill for NCI, right? So you will understand that the goodwill for NCI is not 0. So therefore, we are not using partial GUIL method. Anyway, originally, we got 20%. Originally, we got 20%. On 1st of January, we have got 20%. 20% significant influence, and therefore, starting from 1st of January, we should use equity method. Equity method for associate. So throughout the whole year, we should use the equity method. And then suddenly, on the last day, 31st of December, we purchased 60% more, and therefore on 31st of December, we need to start to consolidate. So we need to calculate the goodwill on 31st of December, and we need to consolidate on the last day, 31st of December. Of course, this question, we use the first day and the last day, right? If actually we acquire 60% on 1st of October, right, then there will be 9-month equity method, 3-month consolidation, right? It will be the case. Anyway, we first use the equity method. Equity method starting from 1st of January. How much we pay? We pay $3 million to acquire this investment. We pay $3 million. So initially, we must have recognized it at cost. So we must have debit investment, $3 million, and credit cash, $3 million. We must have debited investment, $3 million. This $3 million include already all the 3 components. That means the book value of the net asset, fair value adjustments, and the goodwill component. And therefore, there's no separate accounting entry for the fair value adjustments. There's no separate accounting entry for the goodwill, right? Because we simply debit investments, $3 million, which include all the components. But we do know that on 1st of January, there has been some fair value adjustments because the financial statements show that for intangible assets, the fair value is $1.8 million, while there's no book value in the financial statement of the subsidiary. And also for the inventory, the fair value is $1.2 million, while the book value is only $1 million. So for intangible assets and for the inventory, there has been a fair value adjustments component, right? But because this is an associate, there's no separate accounting entry for it. So we use equity method. Equity method means we recognize it at cost, and then we share all the post-acquisition increase in net asset. For this company, the profit after tax for the year is 5 million. So we can share this profit. We share 20%. Right? So that's why the first thing that we do is we debit investment and we credit share of profit of associate, 20% of the 5 million. 5 million is the profit for the year, 20% means 1 million. So we debit investments and we credit share of profit, 1 million. Just a normal equity accounting entry. Certainly, we understand that this 5 million is only the profit reported by that associate. This 5 million profit did not take into account any fair value adjustments. But we know that higher fair value should attract higher amortization. So the question says that for the intangible, it should have a remaining useful life of 6 years. 6 years. That means this 1.8 million fair value adjustments for the intangible asset should be amortized over 6 years. If this is a subsidiary, we will debit amortization expense and we will credit accumulated amortization, or even we credit intangibles, right? But this is not a subsidiary. We don't debit amortization expense. We debit share of profit of associate, right? So this is the additional amortization expense. For a subsidiary, we will credit accumulated amortization. We don't credit accumulated amortization because this is an associate, right? So that's why we credit investment associate. Understand? Why we debit share profit? Because this is an additional amortization expense. Why we credit investments? Because this is an additional accumulated amortization. How about the amount? If this is a subsidiary, of course it will be 1.8 million over 6 years after tax, but this is not a subsidiary, right? So we share only 20% as an associate. So the amount is 1.8 million amortized over 6 years after tax, and we share 20% as an associate. Understand? Yes. So not only intangible assets have got additional amortization, for the inventory has got a fair value increment of 200,000. Right? So the question says that inventory will sold within 3 months from the year end. That means this 200,000 fair value adjustment is no longer required. It has been sold. If this is a subsidiary, you will credit inventory and debit cost of sales, because this fair value adjustment is no longer required. So therefore, if this is a subsidiary, you credit away this inventory that you have debited in your consolidation journal number 1, right? So we credit the inventory and we will debit cost of sales. This is not a subsidiary. We don't debit cost of sales. We debit share of profit. This is not a subsidiary. We don't credit inventory. We credit investment. Right? I just make sure that you still remember how to account for associate, right? So after all this, so if we add together these 3 journal entries, the investment in associate has been increased by 920. 920 debit investment, 920 on a net basis. So that's why someone may combine the 3 journal entry into one. So if you combine the 3 journal entry into one, you may debit investment in associate, 920, and credit share profit of associate, 920. But if you combine them into one, make sure that you do the analysis in detail, right? So you must show that why you have got this 920, right? But personally, I prefer to do the adjustments one by one, Okay, it will be clearer, right? One by one. Okay, anyway, this is an associate for the whole year. Therefore, at the end of the year, you will increase the investment by 920. But when we share the profit, we notice that actually this company has paid out dividend. Dividend declared during the year is 1 million. Because we share the profit, any dividend from this company should not be regarded as dividend income. Otherwise, you count it 2 times, right? You share the profit already. Dividend income from this company should be eliminated. Therefore, now we eliminate. In your own financial statements, you must have recognized that 20% of this 1 million. 20% of 1 million is 200,000. Therefore, we need to debit away the dividend income, 200,000. So we debit dividend income and we credit investment in associate. Okay? Just the normal equity method. After this, your investment in associate at the year end will be 3.72. Will be 3.72. Why? Because initially, the original cost of investments was 3 million. 3 million initially, and then you share the post-acquisition reserve. Therefore, you increase your investment by 920. And then finally, because of the dividend income, you reduce it by 200. So at the end of the year, your investment in associate is 3.72 million. 3.72 million. If this is just a normal equity method, 3.72 million is correct. But on 31st of December, suddenly you purchase another 60%. And now it becomes our 80% subsidiary. 80% subsidiary. And because of this, any previously held interest must be revalued to fair value at the day of acquisition. This is a previously held interest. It must be at fair value at the day of acquisition. The question says that on the day of acquisition, that means 31st of December, the fair value of this 20% is 4 million. So it must be 4 million at the day of acquisition because it should be carried at fair value, 4 million. Okay? So it must be 4 million. So what does that mean? This means you must remeasure it from 3.72 to 4 million. To remeasure it from 3.72 to 4 million, you need to debit investments, 280. So we debit investments, 280. Okay? So this is again a consolidation adjustment. You cannot force the parent to do so, right? Parent financial statements, 3.72 is correct, right? But on consolidation, it must be 4 million at the day of acquisition. So therefore, we debit investments, 280. And our accounting standard requires us that the resulting gain or losses should be recognized in profit and loss. Therefore, we credit gain on deemed disposal. Again, you can call it gain on step acquisition, or you can call it gain on business combination achieved in stages. Anyway, it must be a profit and loss. The accounting treatment is just like we dispose this 20%, and then we purchase 80% at the day of acquisition. So that's why we call it a deemed disposal. Okay? So after these adjustments, investment is 4 million. So therefore, we can calculate our goodwill. Goodwill is calculated as the aggregate of the 3 items against the fair value of the net asset. First item is the consideration. This is the consideration that we pay for the 60% that we newly bought. For this 60%, you pay 12 million. You pay 12 million. So therefore, the first item, consideration, 12 million. Second item is the non-controlling interest. Let's see whether we have got the fair value of non-controlling interest. We don't have, right? But the question says that NCI should be calculated as a proportionate interest in the fair value of S as an entity. And at the day of acquisitions, the fair value of S as an entity is 20 million. This is given by the question. Why? So therefore, proportion of the fair value of the company means 20% of 20 million. 20% of 20 million is 4 million. Right? This is a proportion of the fair value of the company. Okay? Proportion of the fair value of the company, 4 million. Finally, will be the fair value of the previously held interest. That must be 4 million as provided by the question. So this is what we pay. What we pay will be compared with what we get. What we get is the fair value of the net asset. The question says that at the day of acquisition, that means 31st of December. On 31st of December, the fair value is 16 million. But this 16 million did not consider the deferred tax liability. So anyway, there has been two items which have got a fair value adjustment. The first item is the intangibles. Intangibles, now we have got 1.6 million. 1.6 million at fair value. So that's why in the journal entry, you find that we debit intangible assets, 1.6 million. This is for the fair value adjustment. And then for the inventory has got a fair value increment of 400,000. So we debit inventory 400,000. In total, the fair value adjustments is a debit 2 million. Higher fair value will attract deferred tax liability. Therefore, we got a deferred tax liability 400,000. Right? 20% tax rate. Where do you find the tax rate? The tax rate is here. Right? Tax rate is 20%. Okay, so that's why the deferred tax liability should be 400,000. And therefore, the fair value of the net asset after considering the deferred tax liability will be 16 million minus 400,000. That means 15.6 million. This is the figure after deferred tax liability. So what we pay minus what we get is goodwill. Goodwill is 4.4 million. So that's why you have credited your investment in subsidiary 16 million. Why 16 million? Because 12 plus 4 is 16. This represents the investment in subsidiary for all the 80%. For all the 80%. The other 20% is contributed by NCI. So 16 million plus 4 million is the total cost of business combination, what we pay. What we pay will be eliminated against what we get. What we get is first, the book value of the net asset. So we debit away the share capital. We debit away the retained earnings at the day of acquisition. This is the book value of the net asset. Then we have already debited the intangible assets and the inventory with a related deferred tax liability. This is the fair value adjustments. The journal cannot balance. So the balancing figure is goodwill. Of course, the same as what we have calculated. Okay? And here we show that NCI is not measured using partial goodwill method because NCI is 4 million, which is higher than the fair value of the net assets. Right? You do have a goodwill for NCI. That means we are not using partial goodwill method. If we are using partial goodwill method, it must be a proportionate share of the identifiable net asset. It's not, right? We are not using the identifiable net asset to measure the NCI. So this is not partial goodwill method.